Hello everyone, this is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you my North American opening market comment for July 27th. While the dollar was slightly stronger at midday in Europe compared with its opening levels, oddly enough it gained the most against sterling, even though Britain's second quarter GDP figure came out slightly higher than expectations. The cable shot up for a second, but quickly resumed its slide lower after that. Meanwhile, we've got a busy day of U.S. news coming out. For the indicators, durable goods orders are expected to fall and pending home sales are expected to rise, but I don't expect those two indicators to attract much attention today. The U.S. oil inventories are expected to fall by a relatively modest 2 million barrels. Watch the gasoline inventory figures in particular. Inventories of gasoline have been rising despite record levels of consumption. Also, there's talk that inventories at the main transshipment point of Cushing, Oklahoma have been rising. That could pressure prices regardless of the national situation. Net, today's oil inventory figures could be negative for the oil price. Finally, we have the major event of the day, the Federal Open Market Committee, the FOMC meeting. The market's pricing in virtually no chance of a move in rates in either direction. There's no press conference following the meeting, so the statement will be all we have to go on today. The key points in the statement will be how the recovery in payrolls in June affected their view of the job market and whether they continue to, quote, closely monitor global economic and financial developments, unquote, now that Brexit is out of the way and volatility in the markets has really collapsed. Now, while the non-farm payrolls has indeed recovered to about where it was back in December when they hiked rates, the labor market conditions index is still much lower than that. So I'd expect them to talk about how labor market conditions are improving, but aren't there yet. Still, that would be an improvement from last month's assessment, which could be positive for the dollar. As for inflation, the core personal consumption expenditure index, the Fed's target inflation rate, remains close to but still below their 2% target. Not much change from last month, but it's higher than it was when they hiked back in December. Now, one of the things preventing the Fed from hiking before was the strength of the dollar. But the U.S. broad trade-weighted index is virtually unchanged from the day before the 15 December hike, while the stock market is at a record high, which suggests that the currency or the fear of financial markets shouldn't prevent them from hiking. Overall, the FOMC is still much, much more hawkish than the market is. Even the doves on the FOMC seem to expect at least one rate hike this year, while the market isn't fully pricing in that possibility for another 2 years or so. Now, given the fact that conditions are improving, I'd expect the FOMC to take a more hawkish stance than the market is expecting. That should be positive for the dollar, in my humble opinion. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.